But what is the outlook when it comes to Ujjivan Small Finance Bank in terms of FY22, the impact of the second wave, as well as the rise in NPAs and the decline in net interest margins? We'll talk about their financials and lots more with Nitin Chugh, the Managing Director and CEO of the company. Thank you so much for taking time out and joining in. To begin with, let's look at your numbers in greater detail. What has led to your net interest margins declining and a rise in your asset quality, your GNPAs versus the proforma GNPA?
Hi, good morning. Thank you for having me over. I think the reduction in income has been on account of the derecognition of the interest on the GNPA, the non-performing book, and that has led to both shrinking in the NIMs as well as the total income. So that's completely attributed to that. As far as the increase in GNPAs is concerned, I think it was trending in that direction. We had reported nearly 5% pro forma GNPAs for the quarter of December 20, and that's been more or less in that line. Additionally, we haven't written off very much. For the whole of last financial year, we've written off only about 74 crores. So that also has, stayed with the overall GNPA numbers the way it's looked like, the way it looks like in March 21.
I just want to understand for the sector as a whole, how are you looking at the impact of the overall second wave on your, disbursement growth, collections, overall asset quality, provisions, etc.? How do you see this for the sector as a whole being impacted?
Right. See, we deal predominantly with the low-income borrowers as a small finance bank, and nearly 72% of our portfolio is microfinance, which has indeed been the hardest hit in the last year and even during the second wave. Largely on account of three things. One is because of the lockdowns, there is reduced mobility or probably no mobility at all, and people have been unable to go back to their businesses or livelihood. The second, of course, is the change in the demand. There has been a demand shock also, like we've heard from the economists over the last few weeks. That has resulted into a loss of income and cash flows for a lot of the customers who are still able to open their businesses. And the third is a very clear impact of the infections in the rural areas, which has also impacted the, the livelihood in the rural areas. Now, collections efficiencies, I think we reached a fairly healthy number of 94% in March. However, in April, that dropped by about 6% to 88% on account of the, the second wave, which started to show in the form of lockdowns in the second half of April. And in May, while the month is still going on, things are not necessarily any better because of continuing conditions because of the second wave. However, we are hopeful that now that the cases have started to come down and there is a better grip on the overall healthcare situation, we do expect normalization to happen. And in general, the sector is likely to benefit from all the announcements that the Reserve Bank has also made on the 5th of May. And, we're very happy and grateful that it's come very timely. So all of that is getting assessed. And it does seem that this time around, things would be able to recover a lot faster than what we saw the last financial year.
Okay, now you've given us some numbers about April collections. They are below 90. Could you analyze and tell us the impact of that mathematically? If the number falls below 90, how does that start impacting your collections?
It does impact. However, the impact shows up with a lag. So last time around, if you have to draw a parallel, we offered moratorium to practically 100% of our microfinance portfolio. And overall, I think it was nearly 90% of our total portfolio at a bank level that we'd offered a moratorium. So the collections efficiency really picked up only in the second quarter, and they went up to levels of 65% in August and, closer to 80% only by October or thereabout. So this time around, while that is not the situation, April has been a rather sharp drop all across the industry, at least in small finance banks and microfinance. However, what it does look like that we may not have a lag of the same kind that we saw last year, because the recovery could also be a little faster. So it's too early to say that to what extent it will impact on an overall basis for the entire year, but it does seem that the recovery can happen faster, and therefore the temporary shock that we've seen in terms of reduction of collections efficiency in April and in May will hopefully start to recover from the next quarter onwards.
Is it a good idea to compare the second wave and the first wave, surely because the numbers are high and this time rural India has got impacted? The first wave, the fear was high, numbers were low. It did not hit the rural India, but now it's the other way around.
No, you're right, Nikunj. I don't think it's a like-to-like comparison. However, there are both positives as well as negatives. The negatives, of course, you talked about in terms of the spread and the number of people impacted. Most of us have also been impacted at a personal level in some way or the other, which was not the case to that extent the last time around. However, the positives are also very clearly, significant. One, the learnings from the last year are very pronounced. Two, I think most of the banks, including us, are carrying fairly healthy provisions. Three, this time around, because of the vaccination and whatever else that the healthcare infrastructure is going through in terms of being able to manage this, the hope is that the recovery would also be a lot sharper. We have indeed seen the number of cases now starting to come down. The rural areas, of course, are a worry because last time around they were reasonably insulated from the overall COVID wave. This time around, while they are impacted, I think the recovery might happen with a little bit of a lag. But again, because it's expected that the monsoons would be normal this year as well, we don't expect too much of a change in the economic conditions on a long period basis. It might be just be a temporary disruption that we are seeing, largely on account of the number of cases.
When I speak to some investors who have interest in your stock or investors in your stock or track your stock, they say two things are important. One, what will happen on the entire issue of the holding company structure, and then what will also happen to the new MFI rules if RBI in a sense imposes a cap on the spread. Have you heard anything from RBI? When should we see more clarity on both these aspects?
We haven't heard anything formally, though we have picked up in our regular interactions that the discussion paper for harmonization might be issued by RBI anytime soon. And therefore, when that happens, we will be able to clearly discuss the various contours. However, on our side, when this whole discussion started about harmonization, one of the key things, like you did mention, Nikunj, is about the cap. We have simulated the impact of if at all a cap like that has to come, adjusted for CRR, SLR, etc. We don't see a change of more than 120 to 125 bips in the yields because of that, if at all that has to happen. As far as the holding company structure is concerned, we are in our fifth year of operations. The present guidelines allow us to apply to RBI asking for a reverse merger of the holding company with the bank after we complete 5 years. So I think we will approach that as and when we finish 5 years. In the meantime, in case there are very specific guidelines that are issued by RBI on the basis of the recommendations from the internal working group, then we would want to take a call based on that. But those guidelines are also expected now, I would think, maybe perhaps in this quarter itself.
Okay. Just to understand the broader outlook going forward, Nitin, disbursements, they did improve in March. Would you be going slower now, from here on? What's the trend looking like at this point? The kind of growth outlook you also have for FY22?
We have indeed slowed down our disbursals. One, for the fact that there has been a demand compression of a very large magnitude this time around, largely on account of the three reasons that I mentioned earlier on. However, since we have been able to reach a certain level in the last quarter, predominantly in the month of March, I think our level of preparedness, both on the people distribution side as well as on the technology side, is extremely high. And as and when things start to roll back to normal, I think it will just be a matter of maybe a few weeks that we would be able to restore the normal levels of business. Again, I would like to say that it is dependent on the demand. We do expect the demand to also come back. And on that basis, we do estimate that we should at least get at least 3 quarters in this year, unless, of course, there is a case for a third wave also, which hopefully enough we should not have to go through. But as things stand right now, and if cases the way they are reducing, we do expect things to start normalizing from July onwards. And therefore, if we get 3 clear quarters in the year, I think we should be able to grow in a reasonable manner in this financial year. The exact numbers and all, of course, will get plotted as things start to normalize.
NIMs also saw a bit of a decline due to a de-recognition of interest income. What are the kind of levels you foresee there going forward?
See, NIMs have been cushioned to a large extent due to reduction in our cost of funds, which has happened fairly systematically and to a large extent by almost 120 bits over the last financial year. It has also been cushioned through a systematic reduction in our operating expenses. Our operating expenses to total assets are now at 6.2% versus 8.2% in the last financial year. So there has been a substantial improvement in terms of what you can cushion the yields with. On the other hand, because we have started to move into more formal segments, because we also do need to de-risk the portfolio, diversify the portfolio, we have been making systematic changes to our new customer acquisition strategy and trying to deal with more formal segments, as much as we're trying to also diversify out of microfinance, which is a stated strategy. It does appear that the NIMs will continue to come off. They are unlikely to stay in the same range of 10% to 11% like we've seen in the past when we were only doing microfinance business. However, because of these cushions, and hopefully enough, if the whole situation resolves itself and we don't have to create more provisions or any more de-recognition of income, then the NIMs would likely improve from here, but they would again be in a certain range, and I don't expect them to be going back to the FY19 or FY20 levels because the circumstances have changed, and we are ourselves now looking at dealing with more formal category of customers in a meaningful manner so that we can keep cushioning the book as well.
All right, thank you so much, Nitin, for sharing with us your growth outlook as well as what the view has been on your disbursement growth when you see things normalizing, and as well as the issue of reverse merger.